statements.
All right, so just real quick, the rules of the game are we're going to give a series of clues throughout the presentation to help you pay attention a little bit more. And you're playing for 3 $50 Amazon gift cards. So there's going to be one for the first person who guesses right, and 2 more for people, like 2 people who get it correct, basically. And so when you think you figured it out, you can shoot us an email. We'll have our emails up at the end. And at the end of the webinar, we're going to say the answer. So make sure you have your guesses in by then. And yeah, I think so. Now it's just the first couple of clues. So clue number 1, it comes in many colors. And clue number 2, the thing in the bag is edible. All right, so those are your first 2 clues. Stick on to those, and then we'll get into the meat and potatoes of the thing. So before we get into what the financial statements are, we first wanted to go over a couple of basic terms. And the first one is fund accounting. So you probably see this a lot. HOAs have basically have an operating fund and a reserve fund. And so it's 2 separate sections on your financial statements. So when you hear somebody say fund accounting, that's basically what that means. So your operating is your normal, your landscaping, your your utilities, etc. And then your reserve is your major repairs, like your roof replacements or that kind of stuff. The other thing that I want to go over real quick is the accounting basis. There are 3 types. There's accrual, cash, and modified accrual or modified cash. Those basically mean the same thing. Accrual is the most common. It's the industry standard. When we release an audit, it's typically going to be on accrual basis unless otherwise specified. And basically all it means is that the amount, the assessments line is the amount that was actually billed for the whole year, not the amount that you actually got in. And the expenses are for when the activity was incurred, not when the invoice was paid. So your December landscaping bill that you paid in January needs to be accrued into December. Now, cash basis is not as common, and it's kind of the opposite. So your assessment line is going to be the amount of money that you got in for assessments that year. And your expenses are going to be when you paid them. So if your December landscaping bill came in January, then that's when it gets recorded. And then the third type is modified cash, which is not as common. And it's basically a combo of the 2. It's basically cash basis for all of the expenses, and typically people are keeping track of AR and prepaid assessments. So I just wanted you to be kind of aware of those terms. You might see them a lot, but might not have ever kind of known what they meant. So we just wanted to give you a brief rundown of those. So I'm going to turn it back over to Teresa, and she's going to give you another clue, hint, hint, and tell you how to understand your monthly financial packets.
All right, thanks, Nina. Yes, now we have another clue for what's in the bag, what's in the bag. All right, so the first 2 clues were that it comes in many colors and that you can eat it. And the third clue is it's associated with a particular holiday. So those are your 3 clues so far. All right, so now we're going to talk about how to understand and what all these crazy numbers on your financial statements mean. So we've got slides here where we've got some accounting terms like Nina went over, and then we have some slides for what all these crazy words mean to you. So the first one we're going to go over is the balance sheet. And we've got some red arrows at the top to try to point out the things that we feel are important on this particular slide. So at the top, you'll see that the balance sheet is as of a particular date. So it's like a snapshot on any given date. Okay, and then also the purpose of the balance sheet is to accurately state the assets, liabilities, and equity. So that's a whole lot of accounting words. So let's get into what it actually means to you. All right, so we're just going to start at the top and go on down all of the items on the balance sheet. So the first thing is cash, of course, because cash is king. So normally people think that cash is just whatever's on the bank statement, but that's not necessarily the case, because you can have things that have gone into your books but not actually cleared your bank statement. So for example, if you write a bunch of checks on like December 30th, and you write them early and you get them out in the mail and they're out for everybody to cash, well, the chances of everyone cashing all of those checks by December 31st is pretty much zero. So what you end up having is checks that have reduced your cash balance in your books, but they haven't cleared your bank statement. So that's why your balance on your books doesn't necessarily match the balance on your bank statement. And the two red arrows are to point out that if you do have reserve funds, you'll have operating, usually you show your cash in two different sections. So the operating in the top and then the bottom arrows for the reserve part of your cash. Okay, the next thing is receivables. So the first arrow is the receivables from residents or owners. And that's the most common one because when we bill for the assessments, you know, there's people that are going to be late and haven't paid yet. So that's what that is people, owners or residents that still owe the association for things they've been billed for, such as assessments or fines or those kind of things. A different kind of receivable that you could have, which is the second arrow, is something from a vendor. Maybe you paid one bill twice and then the vendor now owes you back for that second time you've paid the bill. So that could be another example of a receivable that might be on your books. Okay, and then we have prepaid assessments next. Prepaid expenses next, sorry. Okay, so the most common prepaid expense is insurance. So if you pay your insurance bill on July 1st and it goes from your premium goes from, your policy goes from July 1 to June 30, by December 31st, you've only used half of that premium or policy. Okay, so the other half is prepaid. So that's why you end up with prepaid insurance quite a bit. Another example we've seen a lot lately is people prepay their patrol or their security for some reason. So we're seeing a lot of this where, say like in December, you'll pay your January patrol services or security services. So then at December 31st, that's going to be prepaid. All right, so then the next section is liabilities. Okay, so for more accounting terms, liabilities is anything that the association owes to another party, and it could also be short-term or long-term. And there's some examples, but let's go through and let's see what it means to you. So we'll talk about accounts payable and AP accrual together. They're basically the same thing to us, so it's the two red arrows at the top. So this is when the association owes somebody for something. So a good example is utilities, because we all know that like if the meter for the water is read, I don't know, on December 15th, you're probably not going to get the bill till like early January. And then you're not going to actually pay the bill until like the end of January. So we really want to show that expense in December because you use the water in December. So that's when that goes into accounts payable. Let's see. Okay, and then the next one is prepaid assessments. Okay, so this is when owners pay their assessments ahead of time. So if you don't owe your assessment until like January the 2nd, and you're being a good little resident and you go ahead and pay like on December 15th, then you're going to be in that prepaid assessment number until the next month. All right, and then, okay, this one is unearned assessments. Okay, so unearned assessments are usually only for single families because what it is when your annual assessment is billed on January the 1st, none of that is really earned because we like to show the assessments earned as the months go on. So on January 1st, all of your annual assessment is going to be in the unearned assessments. Then by January 31st, the 1 month has been earned, so 11 months are in the unearned. And you just go on down, and then by December 31st, it's all been earned, so there's nothing left in there. Refundable posits. So this is, I know for you owners out there, if you've ever gone to build a pool, you got to pay the association some money in case something goes horribly wrong. And they would keep the money to fix whatever went wrong, but usually you get the money back. So when you pay that full deposit, the association hasn't earned it or isn't going to keep it, so they owe it back to you. So that's why that would be on the liabilities. Okay, and the next one is notes payable. Now we're seeing this more and more because of the natural disasters and all that kind of thing. So just note that when you have debt, when you owe the bank back money that you've borrowed to fix your roofs or whatever you're fixing, then it goes in its own separate. There, I finally did it. I knew I was going to point at a screen that you guys can't see. So there you go. I finally did it. At the red arrows there is where your debt would go on your balance sheet. Okay. Equity. This is the most popular question and the hardest one to explain. So for us, it's just assets minus liabilities is your equity. But that's not good enough for most people. So we've tried to come up with a way to explain it better so you have some feel for how it gets there. So what we've done, what we've thought of is it's really all of the net incomes since the beginning of time for the association. Whether it's losses or profits, it doesn't matter. It's all those added up together since the beginning, and that's what your equity is. I know that's probably the hardest concept and the hardest one to explain. So that's where it comes from. Okay, and then just the rule of thumb for in general, your assets need to equal your liabilities and equity. Okay. All right, now we're going to transition from the balance sheet to the income statement, and it seems like it would be time for.
Okay, Teresa, looks like you are having technical difficulties there. It looks like your screen is paused there, your video.
We're working on it.
There you go.
We are aware. Is that better?
There you go.
All right. So, okay, to do that, we're going to talk about the reserve fund, because before this, we've been talking mostly about operating fund things. Like Nina said, that's just your normal everyday landscaping and utilities and those kind of things. So now the reserve fund is your things that only happen like once every 10 or 20 years. So a new roof, or that coating they put on the outside of the buildings, or elevator modernization, those kind of things. So the tricky part about this is that depending on who's doing your books, the activity for the reserve fund could either be on the balance sheet, which is on this screen with the red marks. So you can see, and if you read the descriptions on these lines, you can see it's kind of like a little mini income statement where you've got your revenue near the top there, and then that bottom third section is your expenses. So that's one way that the reserve activity is presented. And then on this screen, it has its very own income statement. So you can see it's got revenue and then your expenses. And it's a hard concept. It just depends on who's doing your books. If you guys have particular examples and want us to look at it afterwards, we'll do that for you. But those are the two common ways that we see the reserve fund activity presented. Okay, now we're going to transition to the income statement. And we're not going to spend nearly the time on this one because I know that this is what people look at. So when you get your little packets, everybody goes right to the income statement, and that's what they check out, and not so much on the balance sheet, which is why we spent more time on the balance sheet. So the income statement can be a statement of income and expenses. It can be a P&L, it can be a profit or loss. All those words mean the same thing. What I want to point out is that at the top, at the first two red arrows are showing you that the income statement is for a period of time, where the balance sheet was like a snapshot on a certain day. These are for a period of time, so it can be for a month or a year or whatever. And also, like Nina had said earlier, this is where your revenue is recognized when it's billed. It has nothing to do, in this situation, it has nothing to do with any cash received at all. Okay, it's just when it's billed. And then the expenses are similar, where the expenses are from getting invoices in from the vendors, It doesn't have anything to do with money that you actually spent. Okay? So then let's go on to what all this means for you guys. And on this example, we've got towards the left of the income statement, we have just the month and its variances. And then near the middle is the year to date and those variances too. So you can go through and see how each month, month by month, how that compares to your budget. And then you can also see year to date how you're doing compared to the budget. Okay, and then we come down to the surplus or deficit or the bottom line, whatever, all those terms mean the same thing. And we just wanted to point out that associations are considered not-for-profit for most purposes. And so we like to see where the budget comes down to zero, because it's really designed to not make a profit, basically. And then what this means, the bottom line means to you, is that if it's positive, you had more revenue than expenses. And if it's negative, then you have the opposite, which is more expenses than revenue. Okay, now that we understand what all these numbers mean, Nina's going to come back and she is going to tell you how to check all these numbers. And
on top of that, we also have another clue for what's in the bag. So, clue 1 was it comes in many colors. Number 2 is you can eat it. Number 3 is it's associated with a particular holiday. And number 4 is it's often used in counting games. So think about that for a little bit. And we'll move on to how to check your financials. So the first thing that we're going to look at is the bank reconciliation that Teresa was talking about earlier. And so basically it's the report that says, here's the bank balance, here's all the stuff that's outstanding, the deposits that we put in that didn't clear yet, the checks that didn't clear yet, and here's what the balance sheet actually says. So what you want to do with this report is you want to make sure that whatever the line says bank balance, or balance per bank statement, it can have a few different terms, but they all mean the same thing. Just make sure that that agrees to the actual balance on the bank statement down at the bottom. And then any outstanding checks or deposits or something like that aren't from, like, if it's December 31, make sure they're not from like August or June or something like that, so that you don't have anything that's old and needs to be written off or needs to be reissued still outstanding. And then you also want to make sure that the adjusted bank balance, also known as balance per GL, balance per trial balance, balance per balance sheet, any of those, they all mean the same thing. You just want to make sure that that number actually agrees to your balance sheet. And then the next report is your prepaid and AR report, or your accounts receivable and prepaid, or delinquencies and prepaid. They all mean the same thing. There's a number of different names it goes by. And what this shows is the homeowner balances that are owed and what whoever's paid in advance. It's typically broken down by month. So this one actually has the actual month names on it for December, November. Sometimes it's 0 to 30, 31 to 60. And oftentimes they also have a breakdown at the bottom that shows what kind of revenue makes up the report or the balances on the report. So this one has, admin fee, assessments, late fees, etc. So you can go in and look at the codes up above on each individual homeowner and figure out what exactly they owe on. So this is a good report to figure out who should be sent to attorneys. If you've got a bunch who are in the, September and less, or the 90 plus, and that just keeps going up and up, it might be time to send them to attorneys. And the important thing is that these balances really, really need to match the balance sheet. This is a very common place to park suspicious items and fraudulent items. So this is an important report to check and make sure that those balances are agreeing to the balance sheet. Now for prepaid expenses, as Teresa mentioned earlier, it's usually just prepaid insurance, where you take the total premium, you divide it by 12 for each month, and then you apply a 12th every month, and whatever's left is your prepaid. And so that number is going to go down every month, except for once a year when it gets way high. And if the amount never changes, or if you don't know what it is, or you have another like prepaid expense that isn't insurance, take a look at it. If you have any questions, talk to your property manager or your accounting department to see if you can figure out what's going on with that. And here are a few reports as well. They're not as common, but they're common enough that we want to touch base on them. The AP check history is basically a breakdown of all the checks that were written in that particular period of time. The open invoice listing is all the bills that you've had come in, but you haven't actually paid out yet. And then the security deposit report is a listing of all the homeowners who are like building a pool or building a house in the association and have money that, in with the association that's owed back to them. So what we feel you should do with these reports is to check the names of the vendors that are on there, or the homeowners for the security deposit reports. Make sure that there's not some weird name that you've never heard of before, or some weird, dollar amounts. Like if your landscaping is usually, $4,500 a month, and all of a sudden it's $7,600, you would take a look at that. And so if something looks off, or like it's super old or doesn't agree to the balance sheet, talk to your property manager or your accounting department and get to the bottom of it. And then the last report we wanted to touch base on is the general ledger. This to us is probably the most important document that we use because it shows activity for every single account for the selected period. So the one we usually look at is from January 1 through December 31, and it shows every single cash transaction, every single AR transaction, everything that we just went through has all the detail for it. And when there's something weird that we want to look at, we'll take a look at that and we'll go to the GL and figure out what the detail is. So this is a great tool if you're curious about what's going on those reports to see what's actually happening. And in addition, we also have this handy dandy little checklist that actually lists everything that I just went over. And we have it both in a laminated PDF and we have it in an Excel thing so that you can use it and have a little checklist every month. And we feel that if you follow these suggestions, you will be well on your way to having some healthy financials. And that'll about do it for us, except we have one last clue from Teresa.
What's in the bag? What's in the bag? All right, the last clue is the object in question shares a word with one of the words in our tagline,
which is in 3 different places right now. So hopefully you can read it, but if you can't, it says your Lone Star bean counters. Yep. So we hope that you enjoyed your time. We're going to tell you what the actual answer is at the end of the webinar during the Q&A session. So please take down our emails and we will be happy to take your guesses. Thank you so much. We appreciate your time.
Thanks.
Thanks, Teresa. Thanks, Nina. Derek, thanks for sharing that screen. And so, great information. We'll reserve the prize, which is exciting. I'm excited to hear what that is. Towards the end, we do have some questions that were submitted, so we'll answer those here in a few. Right now, we're going to kick it over to Scott Scarsborough, who's the managing partner with Kennedy & Kennedy. And so, Scott, if you can share your screen and flip through those slides, I think we'll be ready to go.
All right, wonderful. Thank you, Jesus. Good morning, everyone. Let's see, Jesus, can you see the slides? There we
can
go.
see it. Yep.
How about now?
Perfect.
All right, wonderful. Well, thanks, everyone. We want to talk to you a little bit about budgeting this morning. I am joined with Crystal Chang, who is sitting in our Houston office right now near the Galleria area. And we want to talk to you about what we think is kind of a very important part of HOA financial management. A little bit about me. I'm from Baytown, Texas. I tell people who don't know Baytown, it is the garden spot of the United States. And for those of you who know Baytown, you get a kick out of that comment. But it was home and continues to be home for my family for a long time. We've been serving the community association industry since 1983. So in a few years, that'll be kind of our 40-year anniversary. I graduated from the University of Texas, and for the Aggies in the crowd, we don't have a whole lot to crow about with our either football team right now, so we won't get into that. But probably the most important part of the presentation today is that, again, we've helped community associations for a long time, so we've seen a lot. And, but in addition, we've helped other kind of not-for-profit organizations, and including hospitals and city governments and universities and municipal utility districts, and they all have kind of one thing in common, and that is when they get into financial trouble, it's usually because they have bad budgeting. So when we talk about budgeting, we're actually pretty serious about the topic and believe that if you have good budgeting, you're kind of 80% down the road to really managing your homeowners association really well. The catchy little phrase someone taught me back in high school: if your outgo exceeds your income, then the upkeep will be your downfall. So that's just a nice, clever way of saying, you spend too much, it's going to get you in trouble. And so budgeting is that kind of that management discipline that keeps your organization sound and allows you to satisfy your fiduciary duty, your legal duty as a board member, or your agency relationship duty as a property manager. It is the political season, so I thought I'd include a political quote from a British lawyer, but essentially saying that loose fiscal policy not only gets organizations in trouble, but it also gets governments in trouble over time. So all that by way of saying, this is a pretty important topic. If we look at the Texas Condo Act, it is the association's responsibility to adopt a budget for revenues, expenditures, reserves, collect assessments for the common expenses, and then during the year, because you can't always predict everything perfectly. It's also the responsibility of the board to amend that budget from time to time. Also, in the Texas Condo Act, it gives you the authority to collect assessments, based on that budget that you adopt at least annually. So this is not an optional thing. It's not only a best practice thing. It's part of your legal and fiduciary duty to do it, and hopefully do it well. Okay, so with that, this is probably a nice outline if this topic of budgeting is really new to you. These are the things that we kind of focus on as we help organizations of all sizes, shapes, flavors, to help them, put together a good annual budget, manage their finances well. It all begins with kind of a mission. Is there a consensus around what the mission of this organization, this homeowners association, condo association, whatever the not-for-profit is, what is it that you're trying to achieve with this organization? That usually then translates into kind of a strategic plan. Okay, here's how we're going to go about achieving that mission. And then really important, although we don't see this as often as we would like, here's our 5-year plan for achieving that broader mission and that strategic plan that we put together. So a good budget begins by being consistent with kind of a good 5-year financial plan that, and we give you an example in the slides that you'll get later, but it's a look back. Here's what our finances have been, let's say, for the past 3 years. And here's what we hope they will look like for the next 5 years. And it provides kind of a parameter, a set of guidelines then for adopting that annual budget each year. And then the nature of these organizations, of course, depend on keeping facilities nice and up to date and well maintained. So the annual operating budget and the 5-year financial plan is really your financial plan to set aside the amount of funds that your reserve studies say that you need to set aside to keep your facilities nice. So we always like to see and always recommend, although not legally required, that homeowners associations, condo associations have a reserve study that they're implementing in each annual budget. So based on that, then you adopt the budget. We'll talk more about the details of doing that in a little bit. Budget amendments during the year when things don't quite pan out as you had hoped. And then also having, again, kind of a capital budget for the big capital expenditures, facility expenditures that you're going to have in the current year. Then once you have that budget, then you want to make sure that your accounting system that you're using provides some level of what we call budgetary control. The best systems will actually prevent an expenditure from being recorded if it exceeds the budget. Not all accounting systems do that, but we like to see that the accounting systems that you're using have some type of a systematic control such that you can't overspend that budgeted amount without amending it. Then also critically important, once you've adopted the budget, have the IT controls implemented, that you have what Teresa and Nina showed you, that periodic income statement comparison, budget to actual, ideally monthly, but certainly no less than quarterly, that shows, how are you doing relative to the budget. The board sees that, understands it, and then takes action to correct anything that is inconsistent with the budget. Annual performance reviews, where everyone sits down and says, okay, this was the budget we adopted. Here's how we did. Now, how can we improve in the future? So this is that feedback loop on your budget process so that it can continually get better. And then, of course, if you're a condo association, you've got that legal requirement to have the annual audit of your financial statements. And one of the things that your auditor is going to do is always take a look at how strong or weak are the budgetary controls. And if they see any opportunity for improvement, they'll communicate that to you in what's called a management letter comment, which is essentially, things that would improve the operation of the association and the strengthening of the internal control of those funds, okay? So in the packet that you'll be provided after the meeting, I give you an example of a 5-year financial plan, kind of what that looks like. It's nothing but an Excel spreadsheet. Again, kind of organized by looking back 3 years of your finances and then inserting the one column for the current year budget and then looking forward an additional 4 years. So that every time a budget is put together each year, you go back to this document, update it, and say, okay, we want to adopt a budget consistent with this long-term financial plan. It just makes the annual budgeting process a lot easier if you maintain a 5-year financial plan. Okay, let's talk a little bit about what may be the most difficult part of budget development, and it's not the numbers, it's the people. As everything in life, it's not always getting the numbers to add and subtract. It's getting everyone happy, if that's possible, with the budget that is adopted. So these are some recommendations for you to think about as you put together the annual budget. Start early.
43 what?
Can you say that again?
Sorry about that. Let me mute him.
Okay, no problem. So start early. The best budget processes are participatory processes. These are political processes as well as they are financial processes. So input from all constituencies. You certainly have to know and comply with your governing documents, whatever's in those bylaws or other governing documents pertaining to the development of a budget. Make sure you know what's in those documents. There may be certain calendar events that are specified. There may be financial parameters that are specified. So just make sure you know what's in your governing documents so that when you bring a budget forward, one of the questions you're inevitably going to get is this consistent with our governing documents? When you prepare a budget, it's good to keep a listing of what assumptions that you're making. I mean, you're trying to predict the future. So you're going to have to make some assumptions about the future in the development of those numbers. And it's good just to keep a listing of all of those budgetary assumptions so that when you present the budget either to the board or to a general membership meeting, you can say, now here are the assumptions that we're making. And if we get those wrong, we'll amend the budget during the year. Next point, budget revenues very conservatively. And I think it's always wise to have a budgeted contingency amount in the expense portion of your budget for unknown expenses that could pop up during the year. Consistent with the 5-year financial plan that'll keep you on track, and most importantly, consistent with your reserve study which again, for those who are not familiar with that document, that's telling you how much money you need to set aside every year to keep your facilities up to date and kind of well maintained. Plan for pushback. If you don't get political pushback at a general membership meeting or at the board level, consider yourself lucky, but plan for it. Plan for the person who's had the bad day and who's going to show up and ask the very cantankerous questions. Just plan for it so that it doesn't surprise you. Beware of conflicts of interest. Make sure that there's no brother-in-law of a board member that you don't know about who's all of a sudden budgeted to get a big new contract in the budget. So beware of that. Communicate every way possible. I mean, today there's 1,000 different ways to communicate with people: text, email, Facebook, Instagram, video conferencing software of every flavor and type. Just make sure you're communicating with people so that they can't say, I did not know. Focus on opportunities to improve. People want to, as much as people want to believe in transparency about the challenges your association face, they also want to hear the good news about the opportunities that you're pursuing. And so as a board, as a property manager, there's always that healthy balance between, here are our challenges. On the other hand, here are the things that we're working toward. And a budget needs to be consistent with that same guideline. Last 3 points, board approval. It's not easy being a board member. So there are hard decisions to make, and it is your fiduciary duty to make the hard decisions and do the right thing. And boards have to support their property managers. Being a property manager is a tough job. You're the agent of the board. They're going to get the complaints. The people are going to complain about the property manager. But the property manager is simply the agent of the board. So the board, when they run into difficult personalities or people that are being unreasonable, the board needs to step in and kind of bring that situation down. And budgets are a place where that can happen a lot. And then a lot of bylaws require a budget to be mailed in advance of a general meeting for a kind of a general membership ratification. But again, you need to know what is specific to your kind of governing board documents. In the next several slides that are going to be provided to you, I've taken excerpts from a nice little book entitled The Essentials of Community Association Volunteer Leadership. So if you're a person who learns by listening to others and attending these webinars, that's wonderful. I tend to be more of a learner that needs to read things and study them. So I've included kind of some excerpts in your handouts that kind of walk you through some of the things that I've said. And I won't read to you, there's no reason to do that. You're going to get these. But again, they simply reiterate some of the key points that I've made about, estimating revenues conservatively and expenses liberally, making sure you're funding that reserve study, making sure that you've got a participatory process, and making sure that you budget what your tax liabilities may be for the year, depending on whether you're tax exempt, whether or not you're filing a tax return using the 1120 or 1128 or 990 or some of the other options that you may have. We've also included in the document some examples similar to what Teresa and Nina have provided that give you kind of the standard high level operating budget. But behind this high level operating budget, there may be additional levels of detail the board may request or require. And that's certainly your right to do as a board member. And then the all important kind of periodic budget to actual financial report that, again, for most homeowners associations is done monthly. But for maybe the smaller of the small is less frequently as quarterly, although I've seen a lot of large organizations, especially universities, hospitals, that their board kind of looks at quarterly financials. So that's kind of based on the preference of the board. This is also in the Texas Condo Act, but remember that an annual audit, an independent audit of these records is an annual requirement. A lot of the governing board bylaws will also require kind of an annual audit, but the audit is intended to give that board some level of comfort. Again, not only on the material correctness of the financial statements, but also some feedback in terms of kind of the internal control of the operation of the financial controls over financial reporting. All right, Jesus, that is Budgeting 101. Back to you. What do I need to do? Push a button that says stop share.
You can actually leave that. There you go. That's fine too. That works. So Scott, thanks again for that information. Great stuff. I certainly learned a lot. I know a lot of folks on this call probably did too.
Good.
I'm going to start with a couple of questions that came in through the chat, and then I'll move on to some others that were submitted in advance. So the first one is, I'll give it to you, Scott. Can an audit be conducted on cash or modified cash basis, or do CPAs have to convert to accrual to be Gaap, to comply with Gaap?
Audits can be conducted on any basis of accounting, but it just in the financial report and in our audit opinion letter, we have to be clear as to what that basis of accounting is. But it can be cash, it can be accrual, or it can be the modified accrual where your assessments are kept on an accrual basis, but your expenses are recorded on a cash basis. But those options are available to you. You just have to be very clear in the financial statements and in the audit opinion letter which basis of accounting that is being used.
Yep.
Great. And okay, Teresa and Nina, I'm going to send this one your way. How should associations test owner AR for realizability when having long-term delinquency issues?
So usually what we do is we take a look at the people, it's kind of a twofold thing. So because we have the advantage of looking at the end of the year, so we'll have the assessments receivable at the end of the year, and we'll look at who's materially delinquent. My rule of thumb is typically like whatever double the assessments is, round up to the nearest thousand. So if your assessments are like 1,200 or 600 a year, then I'll make my allowance like 1,500 or so, something like that, just as a rough estimate and then anybody who's above that, I'll take a look at the most recent AR report, and if they're still if they're still not paying, then we include them in the allowance, and then those would be the people that we would send. We'd recommend being sent to attorneys and having more stuff done. But that's what we do.
Great. I think that answers that question. Scott, I'm going to ask you this one, and I'm going to flip through another screen here in a second. In the absence of a reserve study, what is your recommendation for an annual collection for a 12-unit building with no amenities? Let me follow up with that. They submitted another portion of that. Our building is 2.5 years old. The builder did not collect for reserves while we had control of the HOA.
Yeah, I mean, if you're not engaging someone to do a reserve study for you, which would always be kind of the preferred recommendation, then there are a set of steps that you can take to try to estimate those amounts for yourself. In fact, there's a couple of slides in the material that we will be sending out to you that kind of walk you through those steps. What I might do though is I haven't allowed Crystal to answer any questions yet. Crystal, is there anything else that you might suggest to the person who asked that particular question? I think you got to turn your mic on. There you go.
Yes, this is a very common question, like how much money I need to put in reserve fund. But like Scott said, without reserve study, it's just an estimate. It's kind of like you asking like how much money I need to save in order to retire. There's no clear answer, but based on our experience, the rule of thumb, you need to keep about 5% as at least minimum 5% as reserve contribution. But I prefer like you can send us an email and send us a most recent financial, and we'll look at in detail and we'll give you a more clear answer in that case.
Great, thanks, Crystal. Let me go to this next question. Teresa and Nina, I'll kick it over to you. What is the best way to collect for reimbursement for attorney's fees, excluding one unit? Is this able to be done through the operating account or does it need to be handled through a special assessment?
If they're talking about attorney fees that the association paid on behalf of them to try to collect their assessments, then the
That's what it sounds like.
association, is that what they're talking about, you think?
Yeah.
Then the association bills back those attorney fees to that owner. So it's just through normal billing that they would get billed. Whether they collect it or not is another thing, but yeah, it's just through normal billings. After they've paid the attorney, then they bill back the owner.
Great. We've got, let me get here. I don't think I asked this one. When determining the 10% of income to put into an HOA's reserve account for the budget, what income is used? Nina?
I can answer that question.
Or Crystal? There you go.
Yeah, you're supposed to use the total assessment collected as the first number. I mean, total assessment billed, not collected, I'm sorry. It's accrual basis. And then you can have a separate line item, reserve contribution. So you go, when you do the budget, our recommendation is you go from bottom to the top. You start with expense and you talk with the vendors about the contract. Are they going to increase or not? You use previous year actual financials as your reference, and then you go from bottom to the top. And the number one number is the assessment bill, and the second number is reserve contribution. And like Teresa just mentioned, we prefer the bottom number to be zero. Like, you know, it's a nonprofit organization. The goal is just to make sure you collect enough money to meet the operating requirement.
Hey, Sue, you know, that's a really good question. I mean, and a really powerful question. You know, and the bottom line is there is no one answer to that question. There are a lot of best practices answers to that question. I mean, Crystal gave you the best practice answer to that question. I mean, ideally, you want to levy an assessment, an annual assessment that not only provides for the operations of the association, but also funds the annual contribution to the reserve fund or the replacement, you know, facility replacement fund, whatever you want to call it. That is the ideal. So that by doing the ideal, you minimize then the number of special assessments that you need to implement from time to time. And you absolutely, in case of, you know, hurricanes, et cetera, avoid, you know, having to go to the bank and borrow money for something that you didn't have the money to be able to replace when it needed to be replaced. So, you know, those are the ideal, and then you deal with the reality. Because if you're a new board member, you know, you inherit a lot of the past. And so some of what it means to be a board member is unscrambling the egg from the past and trying to move to the ideal.
Great. I've got one more question here. I haven't read it fully. Hopefully it's an appropriate question. Do we use only the assessment income or also income from renting out the clubhouse or selling gate keys? The income from the assessments can be determined at the time the budget is prepared, but any other income is not known until the end of the fiscal year. Whoever wants to answer that one.
We see it pretty often that those don't have budget line items, or if they do, it's based on whatever they had last year as just an estimation. But usually I don't see a whole lot of budget on those particular line items unless you have like a large, it's been going on for a long time, like the clubhouse, you know, you typically have about 6,000, but other than that, it's usually zero up there.
Okay.
You can use the average from previous 5 years expenditure.
Yep, absolutely.
Yeah.
Great. I don't see any other questions. So there was a couple of questions, but what we're going to do right now before we get into the big reveal of the surprise, I am going to you know, formally cut the presentation, and then I think our presenters will be able to stick around for a little bit and answer any more questions in detail. So thank you, Scott, Crystal, Teresa, and Nina. A lot of great information. You know, as a reminder, next week, our chapter, we are hosting Creating a Community Landscape That Rocks webinar. And then the following week, we have a virtual legal seminar. I believe we have 8 presentations over the course of 5 hours. We have Don Bauman, who is the Government Relations Director for CAI National, who will be speaking during our lunch. And so there's an opportunity for you to learn some more there and gain some CE credit as well. That information is all up on our website, caihouston.org. And so thanks again. Thank you, Capital One, Kyle and Keith, for sponsoring. I really appreciate your support. And so we'll officially end it now. And if you want to stick around, for those of you who can, our presenters will answer a few more questions. Thanks, everyone, and have a great week.
Thanks.
All right, so we have the answer to the what's in the bag, what's in the bag. So we'll go over the answers we got that weren't what we were looking for. So we had lollipops, candy canes, Skittles, and sweetheart candies were some guesses.
Awesome guesses, by the way.
Yeah, but the real answer we were looking for is jelly beans. So the first person to get it right was Michelle from Kennedy and Kennedy. Michelle, you get $50 from Amazon. And then the rest of the people that got it right, we picked random 2 people. And Sandra from 5050 Woodway gets a $50 gift certificate. And then Pam from Crest also had it correct, and you'll get a $50 gift certificate. So thanks for playing, guys, and hope we kept your attention.
Thank you, guys. Appreciate you doing that. Again, thanks again, everyone. And I'm sure you'll coordinate with those winners and get those over to them.
Absolutely.
Thanks, everyone.